Hello, everyone. This is Paul Forchione. I'm one of the Discover Options mentors. Thank you for attending today's session. What I'm going to cover today is what I consider to be a very, very simple strategy that you can use when trading the futures markets given the environment that we see currently. This is what I call a very flexible technique that is suitable for many of today's low implied volatility markets. So I'm going to run through an explanation and show you examples in several markets where you'll see how this strategy works. So the first thing I'm going to do is share my screen, share my desktop with you so that you can see my OptionView software program. Now let's see here. There we go. I'm sharing my desktop. And what you should all be looking at is my quotes display from the OptionView software. What I'd like to encourage each and every one of you to do is to type in whatever questions you may have as I go through the explanation into the chat window. Type it into the chat window, and what I will do is periodically pause and take a look to see what questions you've come up with, and then I will either address them at that point or perhaps save them for later in the presentation. Let me do a little check here on the chat window. Oh, there we go. Perhaps I can leave this in the corner of my screen so that I'll be able to see when questions do come in. Okay, well, basically, what I have here is all of the various futures markets in alphabetical order. And what I generally will do is start at the very top. I will highlight the very first market. In this case, it's 6A, which is the Australian dollar. And then what I will do is click on the price chart, pull up a price chart along with a volatility chart superimposed, and I'll eyeball this situation. And what this market, the Australian dollar, shows me is that we are in a severe downtrend for the Australian dollar futures prices. And when I look at the blue implied volatility line and when I look at the brown statistical volatility line, it tells me a lot of additional information. The brown statistical volatility line is telling me that the futures contract for the Australian dollar is moving in a very aggressive fashion. The fact that the brown implied volatility line has been rising since May 8th to where we are today on May 20th, it's telling me that the magnitude of the daily ranges in the Australian dollar is increasing. It doesn't tell me anything about the trend of the market, but it tells me that the daily bars are widening as the market is moving. The blue implied volatility line has also been rising over the last couple of weeks, and that tells us that option premiums on the Australian dollar futures contract have been increasing. Put and call premiums, the time premium in those options has been escalating as the market has been moving. What this also tells me is that because the current reading of the blue implied volatility line, which is 10.4%, you can see that on the bottom of the screen, and the current reading for the statistical volatility line, 13.5%, it's telling us that statistical volatility is higher than implied. It's telling us that options traders are not fully pricing into the premiums on the options the degree that the Australian dollar futures are moving. That's one definition, one way of saying that Australian dollar options are undervalued. They're undervalued on a current basis. Now, there's another way of evaluating whether options are under or overvalued, and that's to look back at where implied volatility has been in the past. Well, you can see that right now, this current blue line with the 10.4% reading is quite a bit higher than where it's been since, actually since probably right around here in August of 2012. But if you click the letter V in the lower left-hand corner of this screen, you can get averages for different periods of time. So the current 10.4% implied volatility reading is actually pretty high in relation to where implied volatility has been over the last 3 weeks, 6 weeks, 10 weeks, even a year and a half. It's only low relative to the 6-year average of implied volatility, which is 14.2%, or the last 4.5 years. So you have many different ways of using this particular screen in OptionView to make your judgment or assessment about the relative under or overvaluation of implied volatility. Now, I chose the Australian dollar because it's the very first futures market I have on my list. If I now go to my keyboard and press the page down key, it automatically goes to the next item on the list, which is the British pound, then the Canadian dollar, then the euro currency. So you can scroll through all of the different markets to get kind of a pretty good idea as to which markets have under or overvalued options. So if we go back to the second one on the list, the British pound, and I pull that one up, we also have a situation where the blue line is significantly below the brown line. So on a current basis, implied volatility in the British pound options is low. If we click the letter V in the lower left corner, the current reading for implied of 7.9% really is pretty much where we've seen implied volatility over the last 3, 6, 10 weeks, even over the last year and a half. Only when you look at maybe the 4.5 to 6 year average number for implied can you say that implied volatility is low from a historical standpoint. So this is the kind of analysis that I think as an options trader you really want to do. You want to look not only at what the bar chart of historical prices has been for the commodity, but you want to look at what's going on underneath the surface. You want to look at these measures of implied and statistical volatility. Okay, I do see some questions have come in. Let me check and see what they are here. How do I get IV and HV? HV meaning historical volatility, or what OptionView calls statistical volatility. How do I get those to show up on the price chart? Well, the way I get them is by clicking or unclicking this little box in the upper left corner, the second box from the left. As I click it and unclick it, or as I repeatedly click it, you'll see the implied and the statistical lines will appear or disappear. Another question, is the black line just a front expiration or a blend of several? Well, the black line is the bar chart of historical prices on the futures. And OptionView does display that black line as a blend of several futures contracts for the British pound. It gives the heaviest weighting to the front month with the most volume and open interest, and then it uses a lesser weighting factor for the deferred month futures contracts. So it's what's called a continuous chart. If you were to compare this continuous chart with a chart from another service on a specific British pound futures contract, you would find that it's going to look a little bit different. But nevertheless, you can get a very good idea as to how the British pound is moving by looking at this bar chart of the continuous contract. Okay, so what I want to show you now is the following. If we take a look at this contract, the ZB, which happens to be the 30-year government bonds, and if I pull up the, first I'll pull up the matrix, have the program get all of the current prices. Then I'll click the price chart, and this clearly shows that we have a situation where there's a big divergence, a big separation between the blue implied volatility of 8.1 and the statistical or historical volatility on the futures of 11.9. So currently, bond options are undervalued in relation to how much bond futures have been moving. If we click the V, we can see that the implied reading of 8.1 falls in line with where we've seen our averages over the last 3, 6, and 10 weeks. The current reading is a little bit lower, however, than the 1.5, 3 year, 4.5 years, or 6 years. So you could say, from a historical perspective, bond option implied volatility is probably fairly priced, but it's not fully reflecting how much the bonds have been moving. So let's look at an example of an option spread that can take advantage of this situation. Because as an options trader, you really want to do more than simply forecast market direction. You want to try to take advantage of under or overvalued option situations so that you can obtain what's called a theoretical trading edge or a trading advantage. That's one of the reasons to use options, aside from many other reasons. So let's take a look. I'll get rid of the IV and SV lines, and let's look at the futures themselves. They've been moving around quite a bit. They were in a big uptrend from the beginning of first week in March all the way to the first week in May. Then we went into a steep downtrend over the last couple of weeks, and now they're sort of chopping around. So let's assume, to start with, that you are bearish on bonds, that you think they're going to continue to move lower from here. So if they're going to move lower, that means you want to put on a trade that has negative deltas. Negative deltas. Well, the trade strategy we're going to talk about today is a very simple out-of-the-money calendar spread. And we're going to do this with out-of-the-money puts because we want a bearish position. If we're going to work with July and August options, both July and August options are tied to the September futures. So if we look at the September futures at the 143 level, if we go and look at the puts with a lower strike price than 143, for example, the 140s, an out-of-the-money put calendar spread would be the following. One of them would be selling the July 140 put, buying the August 140 put. It's bearish because the delta on the put that you're buying in August is 25. The delta that you're selling on the put in July is 18 or 19. So it's a net negative delta, and underneath this you can see the delta is -6. The theta, or positive time decay, is about $4.50 starting out per day. And the Vega factor is plus 82.91, essentially 82 or $83 of benefit if implied volatility on bond options rises by 1 percentage point. When we looked at that chart earlier, it showed the current implied volatility on bond options was 8.1%. So this is telling us if the implied on the bond options rises from 8.1 to 9.1%, that's a 1 percentage point increase, this spread will earn $82 of profit. If we click the Analyze button and look at the graphic analysis, and what I like to do is make sure everything lines up. So I click the Target button, click this for the current price of the futures. It is based on the September futures. Click OK, and then I like to change. What I do is then I right-click my mouse while I'm pointing at the screen, and I change the interval to whatever I desire. In this case, I'm going to put in apostrophe 16. That's 1/2 of a bond point, 16/30 seconds. And then want to make sure the wand is at the right level, so I press that. Now everything's lined up, and you can see the black dot intersects the first performance curve, the red T+0 performance curve, and it shows us that clearly the minute you put this trade on, if the bond market drops in price, if the bonds sell off, you're going to generate some small profits. Small profits because it's a very small negative delta on this trade starting out. However, we're not really putting this trade on to make money in one day or immediately. We're putting this trade on because we're anticipating that over the next, say, 17 days, or if I change the number of lines to 4 lines, over the next 22 days or 3 weeks, if that's our anticipated holding period, you can see that there's profits that will be earned as the market moves lower. And if the market were to move lower by 2 full points over the next 3 weeks, if we drop down to the 141 level, the trade earns $312, and that's all from positive time decay. If we are also correct and implied volatility rises in this market, because that's what we're expecting as the market declines, then we're going to earn additional profits. How much? Well, look at the Vega factor. The Vega factor at the 141 level is plus 106. So when I see that we're going to have $312 of profit in 22 days with a decline in the market, we're going to earn an extra $106. That's going to become essentially $418 roughly, which I can assume, or I can project by putting a 1 percentage point increase in volatility on the left-hand side. And now you see the P&L is showing it's $406. That is clearly a very good return on the cost or the margin of putting this trade on, $531. How much is it? Well, you can change the x-axis by going to this section here and clicking on yield. That's a 76% return on margin in a 3-week period. Needless to say, that's extremely good. Even if the bond market were to stay at its current level, but implied volatility were to increase by 1 percentage point, this trade is still going to make a 32% return on margin, which happens to be $172 in profit. So you can see that this is a trade strategy that factors in market direction, and it factors in an increase of implied volatility. The Vega factor is what gives you the conversion of the rise in IV to dollars of profit. The nice thing about it is if you're wrong and the market rallies, the losses are rather small. They're small immediately. They're even small in 3 weeks' time. All of these lines tend to converge at this, say, 144.18 level, a $109 loss. Of course, that's assuming IV does not change. If implied volatility does go up as the market rallies, you're going to break even at that level. So you really don't lose anything anyway. So the nice thing about using an out-of-the-money put calendar is that your deltas are small starting out. Consequently, an unfavorable move in the market, in this case a rally, will not lead to large losses. They will be manageable small losses. And if the market moves in the direction that you desire, then the profits will build both immediately and as well as over time. So the key here is with the bonds, we did have a situation where we had an undervalued theoretical situation where the blue line was below the brown line. And so we're assuming, based upon all kinds of studies that various academics have done in the past, we're assuming that these studies will hold true, namely that the conclusion of these studies is that over time, implied volatility is a mean reverting variable, which means over time, implied volatility tends to gravitate to its average level, its long-term average level. And we did see when we click this V button here that the long-term level is right around, maybe 10 to 12%. And since we're currently at 8.1, we do have the theoretical advantage from a historical perspective, and we have the theoretical advantage from a current perspective because the 8.1 current reading is a lot lower than the current SV of 11.9%. So this is a good market right now for anyone who is bearish to put on a trade similar like to this. Now I chose the 140 put with July and August to obtain a net delta of -6 on the spread. What if I were to choose the 137 put and do a 137 calendar put spread? Let's see what that looks like. Looks a whole lot different, a tremendous amount different. And that's because we are expecting, when you put on this trade, a much larger decline in the market. And if you do have a much larger decline in the market, you're going to generate much larger profits as compared to the previous trade. So if we go down to the 139 level and 139.18 level, this shows a $344 profit. If we go back to our previous trade, it's a $437 profit. Well, I have to make sure we're comparing apples to apples. 0% change, the 344 versus, isn't that interesting? They're identical at this particular level. If it's moved to the 141 level, this 137 put calendar makes $141. This one makes $328. So the 140 calendar makes a lot more money in 22 days with a more modest decline as compared to this trade. So you have to decide how bearish are you, how big of a move do you expect, and how much are you willing to risk with an unfavorable move. So you need to experiment with different levels of out-of-the-money put spreads. Okay, what if you, however, were not bearish on this market? What if you thought this market's bottomed out and now we're going to get a recovery to the upside? And certainly there are people who are looking for a move up in bonds, especially if you happen to be in the court of those people who are expecting a sell-off in stocks to come at some point. We're long overdue on a sell-off on stocks, and if that happens, bonds are probably going to rally. So what would you do? You would look for an out-of-the-money call calendar spread. So if you went with the out-of-the-money, let's say 146 call in July that you sell, and you buy the August one, now your 8 delta is long, and we have a positive Vega factor. You can see that as the market rallies, the spread earns money, especially after 3 weeks, and the losses on the downside are modest, just like the losses on the upside were modest with the put calendar. So you have a choice here, depending on whether you're bullish or bearish, how you want to structure your trade. You either go with out-of-the-money calls if you're bullish, go with out-of-the-money puts if you're bearish. Now, if you have a trade like this and the market declines, let's say it drops down by this would be basically about 1.5 points. Now you've got a loss in 3 weeks. You can go ahead and close the trade and take your loss. If implied volatility moves in your favor, the loss is going to be very small. But the thing to focus on is your deltas. Your deltas are getting increasingly long as the market moves against you, as the market declines. Obviously, that's why the position loses money. So you have a choice. The choice is close the trade, take your loss, start over in another market or start over with a new trade here, or you can adjust this trade. You can adjust this trade by modifying your deltas, making your delta less positive, maybe even just getting back to a delta neutral position where you're going to earn some positive time decay, because at this point the trade actually doesn't even earn positive time decay, and beta turns out to be negative. So what could you do? To get negative deltas, you can do a vertical spread with calls, a credit call spread to obtain negative deltas. What does that really mean? Well, if we were to do the following, if we were to sell the 144 call in July, and if we were to buy to close the 146 call in July, that's a credit call spread. It achieves what you're looking for. It achieves negative deltas, and it achieves positive beta. And here's what the resulting position would look like. We have changed our 146 calendar call spread into a diagonal calendar call spread, where now we are short the 144 call, long the 146 call. And at this level, 141.18.5, now we are 6 deltas short, earning positive beta of $7.50 a day, and the vega is still positive, but not quite as positive as it was with our original position. Our original position had vega of 106, but now it's only vega positive by 38, which is fine. Still, what we've done though is we've eliminated our downside exposure, and we're giving ourselves a chance with the passage of time to generate more positive time decay to compensate for the small loss that we would have incurred when the market moved down in the first place. So you can always adjust these calendar spreads with a vertical spread to change your deltas. Okay, let's see. I see there is a question here. If the IV to SV comparison suggests that options are undervalued, when we look at individual strikes modeled by Black-Scholes, will they all be undervalued? Well, what you're really asking is, how can we make a determination of under or overvaluations when all we're really dealing with is 2 particular strikes, when there's so many other strikes with puts and calls? And how do we know that a global implied volatility assumption is going to apply to the particular options that we have? Well, there are no guarantees, but generally when you do have an IV, an implied volatility, rise or fall, it generally does affect, maybe not to the exact same degree, but it does affect all of the puts and calls, all of the strikes, because if it didn't, there are arbitrage opportunities that the professional floor traders and professional market makers will arbitrage away. So you really just have to kind of go on that assumption. That's one of the reasons why people are still trading on the floor at the exchange. They have these opportunities to arbitrage the little differences between implied volatility between strikes. Retail traders don't necessarily have that ability because they're paying higher commissions. They don't have instant access to order flow. But you can generally assume that the volatility will move in somewhat of a uniform fashion, based on the volatility skew in each month for the options that you are dealing with, as well as all the other ones. Okay, let's go to a different market. I just showed you Treasury bonds. Let's take a look at crude oil. Crude oil. What do we have here? We've got a market that's been moving around a lot, obviously, and we also have a big divergence between the blue and the brown lines. And that divergence really didn't take hold until I'd say mid-April to where we are now in mid-May. The blue and the brown lines sort of were pretty close to one another for many, many months. They did diverge back here in the middle of 2012, and they are diverging now as well. So here we have an undervalued situation on a current basis. If we look back at the averages over different time frames, the current implied volatility of 21.2 is pretty much where we've been over the last 10 weeks, but it's quite a bit lower than where the market for implied volatility has been in the last year and a half to 6 years. So as a matter of fact, this reading of 21.2% currently as compared to the 6-year implied reading of 37.0% is very, very low. And that's why you see the number 2 in brackets up here at the top of the chart, IV with 2 in square brackets. It's telling us that 98% of the time over the last 6 years, implied volatility has been higher than where it is now. So this, again, is a perfect time to put on an out-of-the-money calendar spread, an out-of-the-money calendar spread with calls if you're bullish, an out-of-the-money calendar spread with puts if you're bearish. So let's take a look at something there. Let's say that you're looking for a continuation of this up move, so you're bullish. And let's work with July and August. Now, unlike with bonds, with crude oil, July has a July futures, August has an August futures, but they're essentially the same in price, very similar. So if we were to go with an out-of-the-money call, let's say we go with the 100 call, and we sell that in July, and we buy the August. Now we've got a situation where we're 8 deltas positive, positive time decay, and positive vega. We look at the graphic analysis, and we can see that as the market moves higher, we generate profits. We've got 29 days, 1 month till expiration. If our target holding period is only 15 to 22 days, 2 to 3 weeks, you can see how nicely the profits will grow, especially if we get any kind of a rise in implied volatility. A 2 percentage point rise will add to the profits nicely because the vega factor in this range is essentially 72. You multiply 72 by 2, and that's $144 of profit. That $144 of profit is part of this 740 that you see underneath the x-axis. If you didn't assume the increase in IV, the profits are about $590 or $600. But in either case, the yield, the return on margin, is still very high in a 3-week period. So the problem is only if the market goes down where we start generating losses. At some point, and this is where you as a trader need to have in mind what I call a trigger level. At some point you have to say, I am going to make a change to my position. I'm either going to close it or I'm going to adjust it as the market moves unfavorably. And you can base that decision either on the dollar loss or on the delta factor, either one. So let's say that we change this to $1 on this here, $1 on the intervals, and we'll get everything to line up nicely. So if we had a $1 drop in crude oil, we would have immediately a very small loss. If it dropped $2 on the first day we put this trade on, we're going to have a $190 loss, and our deltas will be plus 11. Perhaps that $2 drop will not be enough to make you change your opinion on the market, but perhaps you want to reduce your downside exposure. So once again, what we would do here to get that positive 11 deltas to be closer to neutral, we would want to do a vertical credit call spread as follows. We could go to the 98.5 call and sell one of those in June or July and buy to close the 100 call. And then what does that do for us? Let's look at the graph. It gets us to being just 1.71 deltas long, essentially delta neutral. It buys us time to wait for the market to start to move back up again, so that over time we'll be able to see profits build in excess of the small loss that we would have incurred when the market dropped. If we had a very significant rally in the market after we put this trade on, I mean a huge rally in the market, you can see that we're actually going to start losing money on this trade if the rally is really strong and occurs with some velocity before too much time goes by. Our deltas are turning negative, and we may need to get our deltas to such a degree that we'll be able to continue to benefit if the market continues to rally. So in this case, since our deltas are negative and we want to continue to benefit with a move upwards, we need to acquire positive deltas. So we do another vertical spread, but this time with puts. So we already have a call position, but now we're going to do a bull put spread. So if we were to, for example, sell a 96 put, and let's say buy a 94 put. I just happen to choose those because if we did get a rally in this market up to that close to 100 and some level, selling a 96 out of the money put and buying an out of the money 94 put will give us positive deltas, and it will give us not quite as much as we need as the market's at 104. So actually what we could do is probably even sell maybe a 99 put and purchase a 96 put. Let's see how that looks. There we go. Now we're like 1.5 deltas long with the ability to earn money with the passage of time. But of course, it is important to remember everything is dynamic. Nothing is static. So our delta on a current basis does change. It becomes slightly delta negative with the passage of time. So that's really why it's important to look at, you know, maybe 4 or 5 timelines and get an idea as to how will your spread behave not only on a current basis, but also as time goes on and as the market moves in either direction. But the nice thing about the adjustment I'm telling you about is that when you do a credit spread with puts on the upside or a credit spread with calls on the downside, you're collecting money. You're getting some of the money back that you spent when you put on the calendar spread. And that adjustment of a credit put spread, excuse me, or a credit call spread also reduces your vega exposure to some degree. So you're doing all kinds of good things. You're getting some cash back, you're reducing your vega exposure, and you're increasing your positive time decay. So nothing wrong with adjustments to either, in a case like this, end up with a 4-legged spread, a calendar spread with calls, and a vertical spread with puts, or in the event that you are hedging against an unfavorable move in the market where you wind up with a diagonal calendar spread, then you are going to still wind up with 2 legs in your position, just a diagonal spread. So the flexibility of reacting to market movement is what makes this simple trading technique very easy to apply. A couple of questions here. Which period will you compare the current IV to? Which period you compare the current IV to determine overvalue or undervalue readings when you click on the V? Well, let's go back to that. When I click on the V and I look at my current reading of 21.2%, I look at each of these different averages, 3 weeks, 6 weeks, 10 weeks, and I can see that my current reading is pretty much all within there. It's only when I get to these higher readings that you could say from a much longer term perspective, from a longer term historical perspective, current readings are low or undervalued. On a current basis, it's fairly valued, except for the fact that it is below the statistical volatility. In other words, the options traders are not pricing enough time premium in the options right now to fully reflect how much movement we're seeing in the futures contract. And that's the factor that, in my mind, overrides the fact that we may be considered to be fairly valued over the last 3, 6, and 10 weeks. We're really not far out of the range as to where it's been in the last 3 weeks, 6 weeks, 10 weeks. But currently, this market is moving a lot, and until the option premiums reflect that by either rising, the blue line rising, or until the market calms down with lesser daily ranges and the brown line comes down, I still conclude that these options are undervalued. Another question here. What application is used here? Is it Trader Workstation or Trade Navigator, etc.? This is OptionView. It's none of the ones you mentioned. This is OptionView. OptionView, OptionVue.com. That's the website. You can learn all about OptionView there. I've been using the program for, gosh, I've lost count of how many years, and it is the software program that I feel is most advantageous for options traders. Let's see. I assume these strategies can be used on other instruments like options on indexes or individual stocks. Absolutely. Yes, they can. Okay. Let's close this crude oil, and let's take a look at the gold market. Pull up the matrix for gold, and then I will pull up the price chart for gold with the implied and statistical volatility lines superimposed. This is a situation where, once again, blue is below the brown line on a current basis. In other words, options are undervalued. Let's take a look at the V here. Now, the current reading for IV, 24.4, is higher than the 3-week, 6-week, 10-week. It's higher than even the 3-year, 4.5-year, 6-year. In other words, from a historical perspective, both short-term and long-term historical, option premiums are rather high in gold right now. Compared to the 6-year average, it's in the 90th percentile. Only 10% of the time has the blue line been higher than this. So this is not the ideal candidate. Even though currently the market's moving so much and the option premiums are not keeping up with the movement in that sense, these are high from a historical perspective. Consequently, it's not the ideal candidate to do these out-of-the-money put calendar spreads. Doesn't mean you can't do it, but it's not the theoretically ideal candidate. There's also the metals market for silver. Let's take a look at silver. By the way, in case some of you aren't aware of it, we've had an enormous range in gold today. Gold was down, well, let's see here. You can see the daily bar here. It got as low on the continuous chart of 1338 and as high as 1392. So we had about a $54 range in gold where it looked very bearish in the morning, but then it turned around and rallied aggressively. Same thing with silver. But let's take a look at the silver chart here. We have a huge disparity between the brown and the blue line. A huge disparity. Implied is 35.5, statistical is 50.5. Huge disparity. If we look at the V, this current reading of 35% is higher than where we've seen it over the last 3 weeks, 6 weeks, 10 weeks, 3.5 years. It's really closer to the 4.5 to 6-year average. So it's not the ideal candidate, but this market moves around so much that you still probably can find some rather interesting positions to do here. Let's take a look at silver. You want to do these out-of-the-money calendar spreads when you have a market that's moving a lot. So if you felt that silver is going to resume its downtrend after its spike higher today, you would want to go with an out-of-the-money put spread. June only has 9 days left for options, so we would go to July and August, both based on the September futures. September futures at 22.73. Let's say that we went with the 20 puts that we sell in July and we buy the August. Now, the thing you have to remember, too, about silver is you don't have tremendous open interest in options like you do in the gold market. So silver, as far as the metals market is concerned, is not as tradable, not as liquid. Here's what this trade looks like. It's an interesting position because if you're looking at a, say, 2.5 to 3 week trade, you can generate some very nice profits with a resumption of the downtrend, especially if implied volatility increases, even just a little bit. And it does not appear that you are taking a huge amount of risk on the upside. The losses are rather small. You can get, let's say, a $2 rally in silver from here in a little more than a week and only lose $155, and that loss becomes mitigated or even lessened if implied volatility moves up. So if it stays at the current level, the losses in 9 days are about $200. But you have to ask yourself, are you willing to risk maybe $200 to possibly earn in 19 days, say $760, or maybe a little bit more than $800? This is where you could say you have maybe a 4-to-1 reward to risk, or a 1-to-4 risk to reward ratio, and that's not bad. So it's just a very simple way to trade with relatively low margins. The margin is essentially the cost of putting the trade on because it's a simple straight calendar spread. And once again, if this market were to move unfavorably, let's say it rallied up here and you wanted to adjust the position, if you're only, it shows you're only like 2 deltas short. Let's see what it looks like if we were to do a bull put spread where we would buy to close the 20 put and sell to open the 21 put. That is a bull put spread, and then your position has, you know, no more risk on the upside. Doesn't really have a lot of, not a lot of great profit potential, but you could earn back the small loss that you incurred on the way up and end up breaking even or have a small profit if you hold it for, you know, instead of 2 weeks, hold it for a month. The interesting thing here that I noticed with silver is, what if you were to put on a calendar spread below the markets and put on a calendar spread above the market with calls? Like let's try this one, the 25 calls in July and August. Now you've got both an out-of-the-money call and an out-of-the-money put calendar. You're spending more money, in this case about $1,500, but interestingly enough, if you were to just hold this trade for 28 days for 1 full month, then you can see how huge the profits are on the upside, even with no implied volatility change, and they're much smaller on the downside. The real risk with this type of a trade is the fact that your vega factor after this 28-day period is in the neighborhood of 149 at the current level, still about 129 at a higher level, or a smaller 74 at the lower level. So the real risk is if this blue line that's currently at 35% drops back to, say, 25%, that would be a 10 percentage point drop in IV. If you factor that in here and now you do your analysis, you can see that the profits on the upside have virtually disappeared. It's only a couple $100 of profit. And on the downside, you have about $400 loss. And it's much worse if the market doesn't move very much and the IV coming down, you end up losing, could be as much as $1,000. So don't underestimate how important you need to factor in a sensitivity analysis to what implied volatility is doing, especially if you're going to be doing dual spreads with puts and calls. Probably not a good idea. It's probably best just to stick with one or the other, because then if the market moves your way, you can have profits right out of the box and take them. If it moves against you, then you can take a small loss and not be overly concerned. Okay, let's see what else we have here. Well, thank you, Samuel. It says great stuff here today. Will there be a link for an offline replay? Yes, OptionView on their website, OptionView.com, or perhaps it's DiscoverOptions.com. We'll have a link to all of the webinars that are done, not just this one, but ones that have been done in the past, where you can go back and listen to them. By the way, I did want to also let you folks know that I do have a personal website, theaceprogram.com, which I just put on the chat window for you to see. And on my personal site, I do have webinars that I've recorded in the past that you can listen to for free. There's like 25 of them. They're an hour each. And I also have what I call premium webinars that are available for purchase, as well as a lot of other educational material in the way of books, ebooks, lessons and articles, DVDs. So I encourage you to take a look at my site and see if there's anything there that would be of interest to you. My email address, in the event you would like to send me an email, is the following. It's owl@west.net. Let's see, another question here. To do adjustments, would you buy out-of-the-money calls or puts or use some other strategies? Well, the only adjustment that I've shown you in today's session was doing credit spreads with puts to obtain positive deltas when you need to adjust a bearishly oriented put calendar. And I've shown you credit spreads with calls to obtain negative deltas when you need to adjust a bullishly oriented out-of-the-money call calendar. If you were to simply buy individual puts or buy individual calls, then what you're going to find is that there's too much negative time decay associated with those, and your entire position will be losing money on a daily basis from negative time decay, which you really don't want. I like the idea of having trades that have some positive time decay, so while you're waiting for the market to behave in the way that your spread will benefit, you generally will earn positive time decay. Let's see here. What is the advantage of using the futures versus an ETF that tracks the futures? Well, the big advantage is ETF contracts are much smaller in their size as compared to a futures contract. And when it's much smaller in dollar size, it means that the options that you're going to trade are going to have much smaller positive time decay. They are going to not provide the type of return that you're looking for. Also, because of the fact that margins are much higher on ETF options trades as compared to margins on futures options trades. It's because ETFs are a stock product and they're regulated by the SEC that imposes much more stringent margin requirements than doing options on futures, which is regulated by the CFTC, and they have more lenient margin requirements that are, so for those two reasons, futures are larger in underlying size, therefore the options give you more positive time decay, and also because the margins are lower on futures than they are on ETFs. Let's see here. Paul, to reiterate, of all the periods available when you click on V, which one do you think is most important, or the one you place more importance on? It's not really a question of picking one. You want to look at all of them to get an idea of where the current reading ranks in relation to the various time periods. I consider the most important to be the current IV reading in relation to the current SV reading, which is what you see with the blue line and the brown line on the current day. How do you use OptionView to look up different futures contracts? Use OptionView to look up different futures contracts. Well, what you can do, let me close what I've got here, and you can go to the, let's see here, View, where is it here? There we go, Look Up. You go to Edit way at the top and go to Look Up. You press Look Up, and if you want to look up assets of a certain type, and you want to look up futures, you put futures in there, and now you've got all of them kind of listed. Everything you could possibly want. If you want to look at indexes, you can put it like that. Various different categories, commodities, bonds. That's the best way to use OptionView to look up a symbol or a name. Okay. Let's see, another question here. These calendar spreads are best used when the underlying market is not trading. Is that correct? Isn't trending, I think is what was meant here. Isn't trending, is that correct? Otherwise, reverse calendar spreads are better used. Well, I would not agree with that, because if you do have a trending market, like if you assume that crude oil is trending up, you can use an out-of-the-money call calendar spread like I just showed you to take advantage of that. But if you wanted to be basically benefiting from not just a move up, but also a move down, then if you did an at-the-money reverse calendar spread, like if you did a buy the 97 call and sell the 98 call, buy the 97 call in July, sell the 97 call in August, because these contracts are right at 97, that's a reverse calendar spread. And you will benefit from a big move in either direction. But the disadvantage of the reverse calendar that's used is the fact that now you have negative time decay. And so time works against you, and you need the market to move one way or the other before too much time goes by, or else you're going to incur a loss. And on top of it, you need implied volatility to decline in order to benefit, because these types of reverse calendar spreads have negative vega. They get hurt when IV goes up. They benefit when IV goes down. So I'm not a big fan of reverse calendars unless you have in a situation in a market where IV is extremely high and the market is moving a huge amount, and you do want to benefit from a big move in either direction. Then you can do a reverse calendar. But right now, what we're seeing in many, many markets is we're seeing a lot of movement, but we are not seeing very high implied volatility. We're seeing the blue line below the brown line in many different markets. And that's why I wanted to make this presentation today, because the time is right to look at some of these, out-of-the-money calendars to take advantage of that. All right, well, I appreciate all of the good questions, and thank you for attending today's webinar. And as I say, check out my site, send me an email if you have other questions. I'd be happy to respond. And hope you all have a good trading day. Thank you.